The United States hardly has any foreign exchange reserves, hardly any. But what we do have, in theory, is a big hoard of gold. What that gold would enable us to do, the dollar really started to fall, and we wanted to defend it. We could take gold and sell it and buy back dollars, right? We can, use our gold to buy back our notes. But if we don't actually have that gold, right? If it turns out that gold isn't there, all hell's going to break. There are some people who think, well, that'll be bad for gold if we don't have it. No. It'll be phenomenal for gold if we don't have it. If the United States doesn't have that gold that we claim to have, gold prices are going to go ballistic and the dollar is going to tank.
The debate over Fort Knox's gold is far from over. Trump's remarks, Musk's social media campaign, and lawmakers' past inquiries have reignited public curiosity about one of America's most closely guarded secrets. It's said to hold around 147 million troy ounces of gold, worth an estimated $425 billion today. Yet for decades, conspiracy theories have swirled about what's actually inside those vaults. Some believe the gold is untouched and safely stacked in its vaults. Others suspect some of it has been secretly sold off or even replaced with gold-painted tungsten bars. PeterSchiff is a financial analyst and CEO of Euro-Pacific Capital, known for his critical views on U.S. monetary policy. In this video, Schiff warns that if an audit reveals missing U.S. gold reserves, the dollar could collapse, raising gold prices. However, he questions the U.S. gold reserves, noting the last audit was in 1953, and speculating it may have been leased, sold, or stolen. However, as deficits soared due to government spending on wars, trust in U.S. gold reserves declined. Countries like France began redeeming dollars for gold, triggering what Schiff describes as a run on the bank, ultimately leading to Nixon closing the gold window in 1971. A U.S. revaluation would likely push gold prices higher worldwide. Market analysts expect price increases of 50 to 200% following revaluation. This rise would benefit gold-producing nations and mining companies. While looking at the big picture, PeterSchiff claims that much of the missing gold could now be in the hands of China, India, Russia, or Saudi Arabia. In 2024, central banks added over 800 metric tons of gold to their reserves. China and Russia led this trend with substantial purchases. Many nations view gold as protection against currency fluctuations and economic uncertainty. This has led to the largest central bank gold buying spree since the 1970s. Banks in emerging markets have been particularly active buyers. These nations aim to reduce their dependence on the U.S. dollar. Now we present the clips of PeterSchiff's insights from their recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
By the way, one of the interesting things that they are talking about right now is doing an audit of the gold in Fort Knox. And I mean, that could open up a hell of a can of worms. First of all, the last time that the gold was audited was 1953. 1953. Not many Americans alive today were alive the last time there was an audit of the U.S. gold holdings. So how do we know that the U.S. government still has all the gold that they claim to have? Well, we don't know. I mean, maybe they don't have it. Maybe it's been leased out. Maybe it's been sold. Who the hell knows, right? Maybe some of it's been stolen. Nobody knows. Now, of course, it doesn't really matter in a sense that it used to matter, because back in the 1950s, when they were auditing the holdings, people who held Federal Reserve notes wanted to know that the gold was there, because that's what those notes were. During the 1960s, when we really started to run up these big deficits for the Great Society programs, War on Poverty, the Vietnam War, the space race, all that crap that we were spending money on that we didn't have taxes, and we started running these deficits, we weren't really doing any audits because we knew, right, that we didn't have enough gold. We didn't have enough gold to make good on our notes, because we had to have enough gold to give everybody with $35 an ounce. And clearly we didn't have enough. And, as the 1960s progressed, right, a lot of our foreign creditors, figured it out for themselves, right? They see all these deficits, they see all the money we're spending, and they're like, there's no way they got the gold. This is bullshit. And, and so I'm just going to cash in now while I can, right? I don't want to be the last man stuck. I want to cash in my Federal Reserve notes now and get dollars, right? I don't want to wait and be SOL, right? When, I want to hurry up and get my gold while I can. And so that's when you started to see like Charles de Gaulle and others, where it was like a run on the bank. Everybody was taking their Federal Reserve notes and saying, give me my gold. And that's when Nixon, he tried to slow it down. He devalued the dollar twice. Okay, we don't have enough. We can't do it at 35. How about 37? And our creditor said, bullshit. I want my gold even at 37. I don't blink you got it. And then we went, we devalued a couple of times. We got to 42. And then we said, screw it. We'll let's shut the gold window, right? That was the only way to stop it. Well, once we left the gold standard in 1971, it really didn't matter how much gold we had because nobody was entitled to any of it. I mean, nobody who owns Federal Reserve notes now believes that they're entitled to any gold, right? It doesn't matter how much gold we have. It's irrelevant because you can't get any gold for your Federal Reserve notes. Now, the relevance might be that's our reserve to support the dollar, right? Because other countries have their reserves in dollars or they have it in euros or yen or pounds or other currencies. The United States hardly has any foreign exchange reserves, hardly any. But what we do have, in theory, is a big hoard of gold. And so what that gold would enable us to do, if the dollar really started to fall, right, and we wanted to defend it, we could take gold and sell it and buy back dollars, right? We can, use our gold to buy back our notes, right? But if we don't actually have that gold, right, if it turns out that gold isn't there, all hell's going to break loose, right? There are some people who think, well, that'll be bad for gold if we don't have it. No. It'll be phenomenal for gold if we don't have it. If the United States doesn't have that gold that we claim to have, gold prices are going to go ballistic and the dollar is going to tank because that means we are defenseless. We have no reserves of anything in order to defend the dollar. And it means the U.S. government needs to buy gold. Well, where's the price going to go if the government doesn't have the gold that everybody thought it had, right? So that is a big deal. And because if we don't have our gold, that doesn't just mean there's more gold in the world. It just means that the gold that China has, the gold that India has, the gold that Russia has, the gold that Saudi Arabia has, is the gold that we used to have, right? That's probably where a lot of these countries got their gold if we sold ours.
Regarding the latest FOMC minutes, PeterSchiff criticizes the Fed's claim of restrictive policy, arguing that inflation remains high and rising. With debt increasing at all levels, he warns that borrowing remains too easy, worsening inflation. Gold often rises when inflation increases, protecting purchasing power when currencies lose value. During the first COVID-19 outbreak in 2020, gold jumped nearly 26% as inflation fears grew. The Federal Reserve's monetary policies directly impact precious metal valuations. Recent PPI data showing 0.4% growth suggests continued inflationary pressures. Trade war scenarios could trigger rapid gold revaluation as the dollar's global dominance faces new challenges. Central banks' expanded balance sheets through quantitative easing create additional market uncertainty. With real interest rates still negative, he warns that consumers and businesses are incentivized to take on more debt, worsening inflation. Schiff argues the Fed must hike rates to curb borrowing but fears a recession. Instead, they maintain an illusion of control as inflation rises, leaving markets questioning their ability to act.
One of the interesting things about the minutes is that they repeatedly spoke about the need to kind of be patient and, hold off on any additional rate cuts. They said that they wanted to maintain their restrictive stance longer and not cut until they have more signs, more evidence that inflation is going back down to 2%. Now, first of all, right now, there's no sign that it's going down to 2% because it's going in the other direction. So they shouldn't even be saying we're looking for more signs. They should be saying we're looking for our first sign, or they should be saying we're looking for signs that the current trend towards higher inflation is transitory, right? They're not really saying how bad it is, but they're saying that they're looking for a sign that inflation is coming down. Well, they're not going to find one. But the interesting part is that they continue to emphasize that their current policy stance is restrictive. It's not restrictive. That is the problem. See, they think that they have restrictive monetary policy, and so they just assume that this restriction is going to lead to lower inflation in the future. So they're just sitting back and waiting for it to happen. But the reality is the policy that is in place right now is stimulative. It's not restrictive. It is fueling the inflation fire. It is not putting it out. And so while they're waiting for inflation to go down, it's going to go up. What they're not talking about in the minutes is raising interest rates, is the possibility that they made a mistake, or the possibility that their current policy rate is not restrictive, because they can't even consider that that's a possibility. But debt continues to increase at all levels in the economy. That is a sign that credit is too loose. Remember, inflation is an expansion of the supply of money and of the supply of credit. So if credit is expanding, you are putting upward pressure on prices. And if your interest rates are still so low that credit is expanding, you are pursuing an inflationary policy. You need to raise rates high enough to contract credit so that people don't borrow money because it's too expensive to borrow money. But people keep borrowing it because it's cheap. And if you look at a real rate of inflation, in fact, not even the real rate, look at the current nominal rate of inflation, right? The last month had inflation up 0.5% in 1 month, or prices. That's 6% inflation if you annualize that. If you annualize the last 3 months of inflation, it's 5%. The Fed funds rate is 4.25%. So if your Fed funds rate is lower than your inflation rate, well, by definition, that's stimulative, right? Because interest rates are negative, right? You're getting paid to borrow money. Remember, I said earlier, the government gets more of what they subsidize. If they're going to pay me to borrow money, if they're going to say, hey, borrow money at 4% and pay it back when inflation is 5%, I'm getting free money. There's no real cost to borrowing. So more people are going to borrow if the government's going to pay you to borrow. What they need to do is ratchet up interest rates to make borrowing expensive, so fewer people will do it. But they don't have the guts to actually choke off all that debt-fueled consumption, because they know that it will produce a recession, and they don't want that. So they don't really want to fight inflation. So they just pretend that their accommodative policy is restrictive. And meanwhile, inflation, as obvious, is going to keep getting worse. The question is, when are they going to do something about it? Or when is the market going to realize that they can't do something about it? Because so far, the market seems to accept, at least superficially, that they got it under control.
Increased market liquidity from monetary stimulus programs pushes investors toward hard assets, strengthening the position of precious metals as wealth preservation tools. As global central banks continue stockpiling gold, shifting away from dollar reliance, Schiff suggests this could signal a broader financial realignment. If a full audit of Fort Knox were conducted today, what would it reveal about the true state of America's gold reserves? And how would markets react? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.